We like to pretend the stock market is a giant calculator. We tell ourselves it is built on balance sheets, discounted cash flows, earnings reports, and cold, elegant mathematics. We buy financial textbooks. We learn to read candles. We convince ourselves that if we just gather enough data, we can solve the equation. We treat price charts like physics, as if every dip has a clear cause, and every rally has a rational explanation. It is a comforting lie. Because if the market were just math, it would be solvable. If financial markets were governed by pure logic, the smartest people in the room would always win. Long-term capital management was a hedge fund run by Nobel Prize-winning economists and mathematical prodigies. Yet it collapsed in 1998. It nearly took the entire global financial system down with it. Quantitative funds equipped with supercomputers and real-time news feeds still suffer catastrophic drawdowns, and retail traders, armed with the sum total of human knowledge in the palm of their hand, consistently make the exact same mistake year after year. They buy at the absolute top out of euphoria, and they panic sell at the bottom out of sheer terror. The math is just the backdrop. The actual engine is human nature. The stock market is not a machine. It never has been. It is something far more volatile, far more unpredictable, and infinitely more dangerous. The market is a giant, global, high-stakes mirror. It does not calculate your worth. It reflects your mind. It takes every unspoken fear, every unearned impulse of arrogance, every desperate need for validation, and it plays it back to you in real time, denominated in dollars. As the legendary financial writer Adam Smith once warned, if you don't know who you are, this is an expensive place to find out. To understand why the market behaves so irrationally, you first have to understand what money actually becomes the moment it enters a brokerage account. To a consumer, money is survival. It is rent, groceries, security, and freedom. But the moment that money is deposited into the stock market, its functional purpose changes completely. It ceases to be purchasing power. It becomes a digital scoreboard. Think about a billionaire hedge fund manager. This is a person who possesses more capital than they or their descendants could ever spend in 10 lifetimes. Rationally, the utility of another $10 million to this individual is absolute zero. It changes nothing about their lifestyle, their comfort, or their security. Yet, they will wake up at 4 in the morning, sweat through 3 shirts, ruin their personal relationships, and take massive structural risks to gain another fractional percentage point of yield. Why? Because they are not playing for purchasing power anymore. They are playing a game. Money in the market is the ultimate point system in an endless, hyper-competitive video game. It provides something far more addictive than material luxury. It provides an immediate, quantifiable measure of ego, intelligence, and dominance. Every green tick on the screen is a dose of dopamine. It confirms that you were right, and the rest of the world was wrong. Every red tick is a public, humiliating declaration that you were mistaken. This is the scoreboard illusion. When you view market capital as points rather than real-world resources, your brain switches. It moves from cold risk preservation to game theory and thrill-seeking. The trading screen becomes a digital casino. But unlike a traditional casino, where the rules are fixed and the house edge is explicit, the financial market tricks you into believing that you are in total control. You are not just betting on a spinning wheel, you are executing a strategy. This creates a terrifying psychological feedback loop. When you win, you do not attribute it to variance or market momentum, you attribute it to your superior intellect. You feel invincible. So you size up your bets, you take on leverage. You start playing not to preserve wealth, but to maintain the emotional high of being right. And that is precisely when the trap snaps shut. Psychologists use Rorschach tests, simple inkblots on a piece of paper, to reveal a patient's subconscious. The inkblot itself contains no intrinsic meaning or narrative. It is entirely neutral. Whatever the patient sees in the shape, be it a monster, a butterfly, or a threat, is a direct projection of their own internal psychology. A stock chart is nothing more than a financial inkblot test. A line moving upward on a screen contains zero inherent emotion. It is simply a record of executed transactions between buyers and sellers. Yet, show that exact same chart to two different people, and you will witness two completely different internal realities. To the person driven by the fear of missing out, that upward line represents a painful loss of opportunity. It triggers a desperate urgency to buy before it goes higher. To the disciplined short seller, that same line looks like an overextended, unsustainable bubble waiting to pop. To the person who bought at the bottom, it feels like validation. To the person who just sold, it feels like regret. The market itself feels nothing. It does not know you exist. It does not know what price you bought at. It does not care about your mortgage. And it has no intention of helping you pay off your debt. It is a vast, indifferent ocean. Market crashes and speculative bubbles are not mechanical breakdowns of the system. They are collective emotional contagions. A market bubble is what happens when millions of individual human minds simultaneously surrender to greed and identity validation. They inflate an asset far past any fundamental reality because the collective high feels too good to stop. A crash is not a mathematical error. It is the sudden, violent realization that the narrative was fake, followed by the raw, primal instinct of self-preservation. Panic is contagious because fear is our oldest evolutionary survival mechanism. When you sit down in front of a trading platform, you are not just analyzing Apple, Tesla, or the S&P 500. You are looking at a mirror. It reflects your unhealed relationship with control, uncertainty, and self-worth. If you are a naturally anxious person, the market will amplify your anxiety. It will push you until you panic sell at the absolute bottom, just to make the emotional pain stop. If you are inherently arrogant, the market will feed your hubris with a few lucky wins. Then it will completely liquidate your account on a trade you were too proud to cut short. The market does not corrupt people. It simply strips away their filters and reveals who they were all along. This brings us back to our core thesis. If you don't know who you are, this is an expensive place to find out. The vast majority of financial losses in the stock market have nothing to do with bad information, terrible stock picks, or crooked Wall Street insiders. They happen because people use the stock market to solve non-financial problems. Consider the person who feels unappreciated or bored in their daily career. They do not approach the market with a cold, multi-year asset allocation plan. They approach it seeking excitement. They want the adrenaline rush of day trading options because it breaks the monotony of their existence. The market gladly accepts their money and charges them a ruinous fee for the entertainment. Consider the person who feels inferior, the person who desperately needs to prove to their friends, family, or social media followers that they are smarter than average. They will not buy a low-cost, boring index fund that compounds quietly over 30 years. That does not satisfy the ego. They buy high-risk, volatile, speculative assets because hitting a 10-bagger is the ultimate proof of intellectual superiority. They are using market capital to buy validation. Or consider the person who suffers from deep-seated regret over lost time. Someone who feels they missed their chance in life and needs to catch up fast. They take on reckless levels of debt and options leverage because slow, methodical wealth creation feels like a death sentence to them. In every single one of these cases, the investor is trying to fix a deep psychological need using a brokerage account. And the market will punish them every single time. Why? Because the financial system is explicitly designed to transfer wealth from the impatient to the patient, from the emotional to the disciplined, and from those who are controlled by their ego to those who have mastered it. When you trade your emotions instead of managing your psychology, You are playing a game where the odds are stacked overwhelmingly against you. You think you are fighting against algorithms, market makers, and institutional whales. But the true enemy is not on the other side of the trade. It is sitting in your chair. It is holding the mouse, and it is convincing itself that this time is different. If there is one fundamental truth to learn from the history of financial markets, it is this. You cannot master the market until you master yourself. You can spend 10,000 hours studying chart patterns, macroeconomics, earnings ratios, and algorithmic trading models. But if you have not spent the time to understand your own psychological triggers, all that technical knowledge will collapse the moment volatility hits. You must know how you react to fear, how you handle success, how you deal with being wrong, and what money actually represents to your inner self. The market is not a math problem to be solved. It is a psychological mirror to be understood. Stop looking at the screen expecting it to give you a formula for easy wealth. Start looking at what your reactions to that screen reveal about you. The most successful investors in human history, from Warren Buffett to Howard Marks, are not necessarily the ones with the highest IQs or the fastest computers. They are the ones with the most unbreakable emotional discipline. They understand that you cannot control the market. You can only control your own mind in response to it. You cannot conquer a mirror. You can only fix the person standing in front of it. If you found this essay valuable and want to go deeper into the hidden architecture of wealth, economic history, and financial psychology, hit the subscribe button and turn on notifications. Welcome to Capital Mindset. We will see you in the next video.